A median-priced home in the United States now costs more than what most working households can qualify to buy. That is not a housing bubble. It is not a temporary rate spike. It is the output of structural choices, decades in the making, that turn shelter into an asset class and scarcity into policy. The real question is not why nobody can afford a house anymore. It is what happens to an economy when they cannot. A middle-income household earning what used to be considered a solid wage now finds the path to homeownership blocked at the very first step. In many metropolitan areas, the price of a so-called starter home has climbed so far beyond the reach of average buyers that even two full-time incomes are often not enough to qualify for a conventional mortgage. According to the latest data, the price-to-income ratio in some cities stands at 12-to-1, while the national average hovers near 5-to-1, both far above the historic norm. For families who do everything right, steady work, careful budgeting, and a reasonable credit score, the realization is stark. The market's entry point has drifted out of sight. The frustration is not limited to a few overheated zip codes. It defines the experience for millions of Americans who expected that homeownership would be a natural milestone. The question is no longer why a few are left out, but why the majority now find themselves locked out. The story of the starter home has become a measure of how far the system has shifted away from its promise. The modern American housing system was constructed on a foundation of federal policy and local practice that defined not only where homes would be built, but who would be allowed to own them. In the 1930s, the Homeowners Loan Corporation created residential security maps that graded neighborhoods from best to hazardous. These maps, now known as redlining, provided a template that lenders and insurers followed for decades. Neighborhoods marked in red, typically home to black families, immigrants, or low-income residents, were systematically denied access to mortgage credit. The FHA underwriting manual, issued in 1938, explicitly instructed lenders to avoid insuring mortgages in racially mixed or minority neighborhoods. The FHA favored new, single-family detached homes in all-white suburbs, and its mortgage insurance made these homes affordable for millions of returning veterans after World War II. The GI Bill's mortgage guarantees further expanded this effect, but the benefits were filtered through the same exclusionary standards. Suburban developments like Levittown became symbols of post-war prosperity, yet their sales contracts often included clauses barring non-white buyers. By 1960, more than two-thirds of all U.S. homes were single-family detached units. This preference was not a market accident, but the outcome of federal incentives and local zoning codes that locked in low-density, owner-occupied development as the national default. Public policy did not simply promote homeownership in the abstract. It determined which groups would accumulate wealth through rising property values and which would remain renters, often excluded from the most desirable neighborhoods. The enduring pattern of exclusion and the dominance of single-family zoning are not relics of the past. They form the architecture that today's housing affordability crisis has inherited, shaping who can buy, where they can live, and how generational wealth is built or denied. In the nation's most sought-after cities, the rules that govern what can be built are as important as the market forces that drive demand. The Wharton Residential Land Use Regulatory Index, which measures local restrictiveness, consistently ranks high-cost metros among the most regulated in the country. In the San Francisco Bay Area, for example, about 83% of residential land is zoned exclusively for single-family homes, leaving little room for denser, more affordable formats. These restrictions are not accidental. Municipal codes, design review boards, and lengthy permitting processes all serve to prioritize existing neighborhood character, often at the expense of new housing capacity. Projects that propose smaller, multifamily, or infill units are frequently the first to be filtered out. In many older cities, legacy zoning frameworks continue to block the addition of duplexes or fourplexes, even as the need for lower-cost options grows. Meanwhile, the cost of delay is significant. In highly regulated metros, approval timelines stretch from 8 months to well over a year, raising costs before a shovel ever hits the ground. While some places like Austin have begun to loosen single-family-only zoning, the overall system still rewards scarcity. Local incentives, whether explicit or implicit, often align with preserving property values rather than expanding access. The result is a persistent shortage that is actively maintained, not simply inherited, through the choices embedded in local land use policy. The American housing market is shaped as much by financial incentives as by physical constraints. For decades, federal tax policy has quietly steered capital toward homeownership. The mortgage interest deduction, introduced in 1913 and expanded over time, allows homeowners to deduct interest on their mortgage debt, lowering the real cost of borrowing, especially for higher-income households who are more likely to itemize deductions. Capital gains exclusions on primary residences and 1,031 exchanges for investment properties further encourage buyers to treat houses as appreciating assets rather than simple shelter. These policies subsidize demand, amplifying competition for a limited pool of homes. When mortgage rates fall, as they did throughout the 2010s, the dynamic intensifies. Cheap capital flows into housing, pushing up prices even as supply remains constrained. In this environment, homes behave less like necessities and more like financial instruments. The rise of institutional investors in the single-family rental market, particularly in Sunbelt metros, has added a new layer of competition. Companies like Invitation Homes and American Homes 4 Rent have acquired tens of thousands of properties, converting owner-occupied stock into rental portfolios. The result is a market where policy, capital, and investor behavior combine to drive prices upward, often before a single new home is built. This layered incentive structure creates a feedback loop as homes become more valuable as assets. The pressure on affordability only grows. The pipeline for new housing in the United States has struggled to keep pace with the needs of a changing population. The share of new homes built as entry-level or starter units has dwindled, while the average size of a new single-family house has grown from about 1,500 square feet in the early 1970s to over 2,200 square feet today. Builders have increasingly focused on larger, more expensive homes, a trend shaped by rising land and material costs that make affordable construction less profitable. According to the Bureau of Labor Statistics, the cost of key materials like lumber and steel has climbed more than 50% since 2000, and skilled labor remains in short supply. Industry surveys report that over 80% of builders face difficulties filling trade positions, leading to longer build times, now averaging 10 to 12 months for a single-family home, compared to 7 to 9 months in previous decades. These delays and cost pressures mean fewer homes reach the market each year. Meanwhile, the number of new households continues to outstrip the supply of new homes, leaving a persistent gap. For many younger adults, the result is a delay in forming independent households, as the market fails to deliver attainable options at the scale required. Home equity in the United States is now concentrated among the wealthiest households. According to the Survey of Consumer Finances, the top 20% hold about 80% of all home equity, while lower-income families have little to no real estate wealth to leverage. As homeownership drifts out of reach for more people, the ability to build wealth through property narrows, deepening the divide between those with housing assets and those without. For workers unable to live near employment centers, the cost is measured not just in dollars, but in hours lost to long commutes and reduced job mobility. Nationally, average commutes now stretch over 30 miles in many metro areas, pushing families farther from opportunity and cutting into disposable income. Outward growth also places new demands on public infrastructure. The Congressional Budget Office estimates suburban sprawl adds roughly $1 trillion per year to national infrastructure costs, with low-density development requiring more roads, utilities, and schools per resident. Meanwhile, rising climate risk has driven up insurance premiums, especially in wildfire and hurricane-prone regions, making some homes effectively unaffordable before a buyer even considers the mortgage. These pressures combine to create a system where the stress of housing costs radiates outward, undermining economic mobility, straining public budgets, and exposing entire regions to greater financial risk. The future of housing in America now stands at a crossroads, shaped by competing pressures and unresolved incentives. One plausible path is aggressive supply reform, eliminating single-family-only zoning, streamlining permits, and supporting modular or higher-density construction. Projections suggest that such measures could reduce price-to-income ratios in high-cost metros by as much as 30% over a decade. Another scenario is the continued financialization of housing, where investor portfolios and tax incentives drive further asset concentration, raising rents and home prices, especially in fast-growing regions. A third possibility is a rate-driven correction. If mortgage rates remain elevated, demand could contract, leading to price pullbacks, but also exposing highly leveraged owners to equity losses. Finally, climate risk and shifting economic opportunities may prompt large-scale regional relocation, with inland metros absorbing new demand as coastal or high-risk areas stagnate. The trajectory from here depends on which constraints are relaxed, which incentives persist, and which risks intensify. The central question is what kind of country will take shape if housing remains out of reach for millions. Today, homeownership no longer signals stability for most Americans. It reflects deep structural divides. As housing remains out of reach for millions, the ripple effects touch growth, mobility, and social cohesion. The true test ahead is whether policy and industry can realign incentives before scarcity erodes opportunity further. Every crisis begins as a crack, small enough to ignore until it isn't.